Right now, the market is acting like the current conflict is just another headline. Stocks haven't fully reacted, volatility is contained, and many investors assume this will pass quickly. But beneath the surface, several macro signals are starting to line up in a way that historically has preceded economic slowdowns. In this video, I'm going to walk through a chain reaction that could develop if the conflict continues, starting with geopolitical geopolitics, moving into oil markets, then into consumers, financial markets, and ultimately recession risk. And how can you avoid all of that? What is my market outlook? First of all, war escalation. The starting point of this macro chain is geopolitical risk. The conflict involving Iran creates two major concerns. First is the possibility of continued military escalation, and second is the potential disruption of global energy supplies, which is actually happening right now in Saudi Arabia, in Qatar, Bahrain, all of these countries that are actually producing oil, importing oil to other countries. We are actually seeing it in real time. Now, this key vulnerability is actually the Strait of Hormuz, where 20% of global supply actually passes through this strait, which is actually one of the most important oil transit routes in the world. If shipping through that route becomes disrupted, which is currently is disrupted, even partially global oil prices can move very quickly. As we have seen right now, oil prices right now is sitting around 95 to 100 bucks a barrel. That brings us to the next stage of the chain reaction, energy markets. Energy prices are one of the most powerful macro forces in the global economy. When oil prices rise sharply, it increases transportation costs, production costs, and ultimately the costs of living households. In other words, higher energy prices act like a tax on the entire economy. Historically, rapid spikes in oil prices have appeared right before several recessions. You can see this pattern during the oil crisis of 1973, the recession around 1980, the slowdown in 1990, the early 2000s recession, and again before the 2008 financial crisis. Now, when energy costs surge, the pressure eventually shows up in consumer spending and business activity. Now, weakening consumer. The next part of the chain is the consumer, because basically this is what moves the markets. Consumers drive the majority of economic activity, especially in the United States. When the consumer weakens, the entire economy slows down. One major difference between today and a few years ago is that the savings buffer that households built during the pandemic has largely disappeared. Saving levels have declined, and more households are starting to feel financial pressure. We're also seeing a rise in hardship withdrawals from retirement accounts like 401ks. In many cases, these withdrawals are being used to cover housing costs or medical expenses. Like when people aren't able to actually withdraw their 401k, their savings, their life savings from 401ks, how will they actually pay for their mortgage or their medical costs or their insurance, etc., etc., etc.? This will cause recessions, exactly like what happened in 2008 and all of these years. Another thing is small businesses are also reporting weaker sales. Around 11% of small businesses now say poor sales are their biggest problem, which historically tends to happen during recessionary environments. Now, here's the thing: when consumers pull back and small businesses start to struggle, the pressure eventually spreads into the financial market. This is where we begin to see early warning signs inside the financial markets themselves. One of the key indicators is the bond market. So the MOVE index, which measures volatility in treasury markets, has recently risen sharply. This suggests that investors are starting to price in more uncertainty around inflation and interest rates. Treasury yields have also been climbing, especially on longer term bonds. This is all a problem. Now, why does this matter? Because if inflation remains a concern, okay, the Federal Reserve has less flexibility to cut interest rates aggressively in response to economic weaknesses. When the Feds don't cut interest rates, what will happen? People will actually borrow less money. And when people borrow less money, there's no more liquidity to inject in the market. Another area of concern is private credit. Some funds in the private credit space have begun limiting withdrawals as redemption requests increase. That doesn't necessarily mean a financial crisis is imminent, but it does suggest liquidity stress may be building. Finally, retail sentiment is fading. Retail equity purchases have dropped significantly, around 30% since the conflict began, and ETF inflows have slowed. Now, these are all early signals that financial conditions could tighten. When you combine these factors, the financial stress, weakening consumers, energy supply shock, and war escalation, we have recession risk. At the same time, policymakers may face constraints. If inflation risks remain elevated because of energy prices, central banks may not be able to stimulate the economy as aggressively as they have during previous downturns. Now, the combination can create a more challenging environment for economic growth. Of course, when inflation risk remains and Fed has less room to cut rates, people won't put their money in risk on assets like tech stocks, crypto, futures, anything that has a lot of risk. Now, what is my market outlook? In the short term, the main implication is higher volatility. If the macro environment deteriorates further, risk assets could face increased pressure. Of course, because people aren't willing to put money in risk assets. However, period of volatility also creates opportunities. Many of the best long-term buying opportunities historically have appeared during times when markets are repricing macro risks. For investors, the key idea right now may simply be patience, capital preservation, and wait for repricing opportunities. So in this time, don't cash is actually king. Not in the long term, in the short term. Why? Because when you actually are invested in something and have a lot of money in something and it goes down, which one do you think is better? To have cash in your hands or to be invested in an asset that is currently going down because of all the geopolitical tensions and maybe a recession. Now, the important thing here in all of this is to understand that markets rarely react immediately to micro crises and macro risks. Often the signals appear gradually across different parts of the systems. Right now, the market still treats this conflict as just another headline, which is actually really dangerous. But if the chain reaction we discussed begins to unfold from energy markets to consumers to financial stress, the macro environment could look very different over the coming months. Thank you guys for watching. If you have any questions, please feel free to comment down below and I will answer them accordingly.